Imagine spending 8 hours staring at flickering candles, executing 15 different trades, and finishing the day in the red, physically exhausted and mentally drained. Many retail traders struggle because they rely on lagging indicators like RSI. This approach misses the fact that markets move based on programmed institutional delivery cycles rather than retail oscillators. In the ICT Silver Bullet framework, time is the primary coordinate on a chart. The market doesn't move randomly. It operates on a specific algorithmic clock. The ICT Silver Bullet Strategy acts as a mechanical intervention. It identifies 60-minute windows where the algorithm is programmed to seek out resting liquidity, filtering out the noise of the other 23 hours. By restricting your activity to these specific windows, you stop reacting to erratic price movement and start aligning your trades with the market's delivery schedule. There are 3 specific windows to mark on your chart: the London Open from 3 to 4 a.m., the New York morning session from 10 to 11 a.m., and the New York afternoon session from 2 to 3 p.m. Eastern Standard Time. These hours are prioritized because they follow major economic data releases. During these times, the algorithm is delivered to specific price points to balance institutional orders and settle the books. Before the window opens, you must establish the draw on liquidity. This answers a single question: where is price likely to go next? On the 1-hour or 4-hour charts, you look for magnets like previous session highs, equal lows, or unfilled fair value gaps. These targets act as the destination for the algorithmic move. Trading without a predefined draw on liquidity is like driving a high-speed car without a GPS. You may move quickly, but you have no way to ensure you are heading toward a high-probability target. Once the New York window hits 10 a.m., we move to the 1-minute chart to identify the execution signature. Step 1 is the liquidity sweep, triggering stop losses. Step 2 is displacement, an energetic opposite move. Step 3 is the market structure shift, breaking a previous swing. Step 4 is the entry. We spot the fair value gap and place a limit order. This 4-step mechanical sequence provides the confirmation needed to show that price is being delivered toward your higher timeframe target. Within the 60-minute window, the algorithm operates on smaller 10 to 20-minute subcycles, known as macros. Macros like the 10:50 a.m. burst act as a pulse of volume. If a trade hasn't reached its target by this time, the macro often provides the final injection of momentum needed to complete the move. By aligning a fair value gap entry with the start of a macro, you combine the timing of the session window with the momentum of the internal algorithmic pulse. Consistency in trading is built on a macro view of performance. This ascending equity curve is the result of repeatable, mechanical execution, rather than chasing every market move. The silver bullet is designed for a 2-to-1 reward-to-risk ratio. By targeting high-probability liquidity pools with this mathematical standard, you remove the emotional pressure to catch the big move. The most critical rule is the walkaway. If the 60-minute window passes without a valid setup, you do not trade. You preserve your capital for the next high-probability window. FXNX provides the tools to support this mechanical approach, from the Silver Bullet Session Indicator for MT4 and MT5 to the ultra-fast execution of an NX1 account. The strategy is defined and the windows are set. Are you prepared to wait for the mechanical setup, or will you continue to trade the noise outside these high-probability hours?